Welcome to Alpha Insights. I'm Joe. Today we're talking about whether the so-called Magnificent Seven can prop up the stock market. My guest is Josh, a market historian who loves telling the stories behind the charts. Remember, if you have questions as we go, you can ask us at stockalpha.ai.
Thanks for having me, Joe. Always good to be here.
So Josh, quick primer. When folks say the Magnificent Seven, who are we talking about?
We're talking about 7 mega-cap technology names that have dominated returns lately. Apple, Amazon, Nvidia, Alphabet, Microsoft, Meta, and Tesla.
Right, and the big point is not just that they're up, but that a handful of them are carrying most of the market's gains. Can you unpack that?
Sure. The headline is simple. A small group of stocks has been doing the heavy lifting for major indices. Recent analysis shows this concentration can amount to roughly about 47% of the contribution to index performance in some stretches. That means nearly half the lift can come from a handful of names.
Wow. So does that mean the rest of the market is lagging?
Exactly. You see dispersion. Some measures point to about 21% differences between leaders and laggards. Other parts of the market have been essentially flat. They're not participating. So headline index gains can mask a lot of underlying weakness. And to add to that, when only a few names lead, the health of indexes is very sensitive to what those names do next.
So the real question here is, can those 7 keep it up and pull the whole market forward?
They can sustain headline momentum in the near term, yes. But the durability of a broad market rally depends on more stocks joining the party, mid-caps, small caps, and other sectors, and on positive, confirmatory catalysts.
Okay. What are the main risks if a rally really is that concentrated?
There are 3 big risks. 1. Concentration risk. If one or more of the big 7 stumble, indices can fall faster than the underlying economy suggests. 2. Valuation sensitivity. These names trade at elevated valuations, so negative news or weaker macro data can trigger sharp repricing. 3. Options and sentiment dynamics. Positioning in options markets can amplify moves and make short-term volatility more pronounced.
Yeah, that's a good point.
I mean, when you look at the data, options flow around companies like Nvidia, and Apple has been a meaningful signal lately. Spikes in implied volatility often precede quick swings in price.
Interesting.
And honestly, I was a bit surprised by how thin breadth has been. Some market measures are sitting in the mid-single digits to low double digits when you compare participation rates. For example, another comparative number sits around about 7% in certain valuation or return comparisons. That tells you leadership is narrow.
So, what should listeners actually watch in the days and weeks ahead?
Look for 4 things. First, earnings and product announcements from the big names. Those remain primary short-term catalysts. Second, options market activity and implied volatility spikes around the biggest names. Big moves there can foreshadow index volatility. Third, market breadth indicators. Things like the percentage of stocks above key moving averages or the proportion of advancing versus declining issues. Fourth, quarterly reports and earnings surprises outside the big 7. Those show whether the rally is broadening.
Got it. So for different investors, this plays out differently.
Yes, growth-oriented allocations that track these mega caps will feel the benefit most. Value investors and small cap holders may see little lift. Analysts have been watching these names closely, which can increase momentum and also make reversals sharper if sentiment shifts.
Short reactions. Right.
Exactly.
Before we wrap, any practical, non-prescriptive ways listeners can think about positioning in this environment?
Think in terms of scenarios, not tips. One approach is staged exposure, scaling into or out of positions so you aren't all in on the winners. Another is monitoring breadth and volatility signals closely and having predefined triggers if concentration metrics shift sharply. And importantly, review portfolio diversification to ensure you're not unintentionally over-indexed to a few names.
Great. Concise and useful. Let's finish with quick takeaways.
Sure.
Key takeaways, Josh?
1. A small group of megacaps is driving a large share of index gains, so headline strength can hide narrow participation. 2. Watch earnings, options flow, and breadth indicators to judge if leadership is broadening. 3. Manage concentration risk through staged exposure and diversification, not as a rule, but as a risk management thought process.
Perfect. If you have questions about anything we discussed today, you can ask us directly at stockalpha.ai. We answer listener questions live. And for more market insights, head over to stockalpha.ai. Thanks for listening, and thanks, Josh.
Thanks, Joe. Always a pleasure.